One of the most exciting experiences in life is purchasing your first home. That being said, one of the most expensive purchases a person makes in their lifetime is also their home. So it is very important to do your research on finding the best home that fits you, buying it at the right price, and making sure you don't run into any issues or extra costs throughout the process. So in this video, I'm going to share with you the exact step-by-step guide to purchasing your dream home in 2025, specifically catered towards condos as they do require more specialized information in Toronto. But this guide also applies to townhomes, detached, and is non-area specific, as this process is very similar, if not identical, to other provinces in Canada. So if you're looking to other types of homes or in other areas in Canada, don't skip out on this video as it has crucial information that can help you make the right choices for purchasing your dream home in 2025. Step 1. Save for the down payment. Depending on the price of the home you would like to purchase, the minimum percentage of down payment required ranges from 5% of the value of the home to 20%. If the value of the home is less than $500,000, you would only require 5% down payment. If it is between $500,000 and $1.5 million, it is 5% of the first $500,000 and 10% of the portion above $500,000. If it is above $1.5 million, it is a flat 20% down payment. However, when your mortgage has less than 20% down payment, your lender will usually require you to get mortgage insurance, which will add to the cost of your monthly payments. So once you know approximately how much you need to save to purchase your home, the next step is to use the three major savings tools like First Home Savings Account, Tax-Free Savings Account, and Registered Retirement Savings Plan, the RRSP, to either invest or save your money using the tax advantages these accounts give you. In my case, I used the TFSA to invest all the savings I had as soon as I hit 18 and later used that investment proceed as the down payment to purchase my first condo in downtown Toronto. But if I could, I would have used the First Home Savings Account as that has both the advantages of the TFSA and RRSP. All three accounts don't tax the gains made within the account, but there are specific advantages and disadvantages of all three accounts. With the RRSP, it has the advantage of having your contributions into the account deducted from your income and reducing that year's taxes. But once you take the money out of the account, it increases your level of income for the year you withdrew the money. Except for one special case, when you use those withdrawals to purchase your home and you haven't owned a principal residence in the past 4 years. You can withdraw up to $60,000 from your RRSP, non-taxable, to purchase your home as long as you recontribute that amount back into your RRSP within 15 years. Your contribution room is generally 18% of your previous year's income for your RRSP, up to $32,490 in 2025, and any unused contribution room is carried forward to future years. Let me give you an example to give you a grasp of how an RRSP works. If you've earned $100,000 in 2024 and you contribute $18,000 into your RRSP in 2025, and your annual income for 2025 will be reduced by $18,000 to $82,000 for tax purposes. Later, if that $18,000 investment increases to $30,000 in 2027 and you made the same $100,000 in 2027 and you take out $30,000 out of your RRSP, your income will be $130,000 in 2027 for tax purposes. The advantage of deferring taxes to future years gives exponential returns on those savings the longer it sits in the RRSP. On the other hand, the TFSA doesn't have the advantage of having your contributions to your TFSA tax deductible, but any money taken out of the TFSA is non-taxable. The contribution limit for each year is simply shown in this chart and is carried forward for any contribution room you haven't used in previous years while you were the age of 18 or older. For example, if you turned 18 in 2019 and never contributed to your TFSA before, your annual contribution limit for 2025 will be $44,500. Now, when you mix both the tax deducted benefits of the RRSP and non-taxable withdrawal benefits of the TFSA, you get the FHSA. The contribution limit is $8,000 per year, with any unused contribution room carrying forward up to a maximum of $40,000, and has been introduced recently in 2023. If you are a first-time homebuyer, the FHSA is what you would want to max out first, and then decide whether it's better to contribute to your RRSP and TFSA after. Whether it's better to maximize your RRSP or TFSA would depend on the level of income you are earning, the returns you can generate from investing, and when you would like to withdraw the funds. But generally, if your income is above $100,000 to $110,000, I would highly recommend maximizing your RRSP first, as you get an instantaneous return of approximately 37 cents per dollar on tax deductions as your income bracket is high. Step 2. Get a pre-approval. Once you've saved up for a down payment and before you can go home shopping, you should get a pre-approval from your bank or a mortgage broker to estimate how much you can afford. At the time of making this video, depending on your credit, other loans, and many other factors, you'll be able to receive approximately 4.5 times your annual income as a mortgage. So if you earn $80,000 a year, for example, that is approximately $360,000 in mortgage you will be able to receive. You can get this usually through your bank or a mortgage broker. The benefit of a mortgage broker is that through one credit check, they'll be able to get you a quote from many other financial institutions and try to find the best quote for you. But many times, you can find the best rates possible even just through the big 5 banks in Canada. Step 3. Hire a real estate agent. Now that you know exactly how much you can afford, you have to hire a real estate agent to help you look for a home, write offers, and give you professional consultation on how to find the best home for the best value. One tip I would recommend is try finding an agent who knows your desired neighborhood in and out, has a lot of integrity, and has the same interests in homes as you. If the agent doesn't have enough time to pay attention to what you want in a home and takes a lot of time replying back to you, I would say find someone else, as you'll be doing more of the work than they would. In Canada, sellers pay both agents in the deal, so as a buyer, there is no cost to you using an agent. Step 4. Find your perfect home. Make sure it checks these boxes. To the most exciting part of the process, there are many important things you have to consider when looking for the home you desire. First is location. This is something you have to be careful with. Just because you think it's in one of the best locations in Canada or in the heart of downtown doesn't mean it'll be the best investment that yields the highest returns. Yonge and Eglinton area prices have barely appreciated in the past 5 to 6 years as an oversupply of condos have kept up with general demand, even though we might think it must have had to go up with the new LRT. To get ahead of the curve, here's a tip that many realtors don't even know. Go to urbantoronto.ca and on the map section, you can see planned future projects in black, currently building projects in red, and already built projects in blue. When you click into the project, you can see some of the details like the project type, stories, and number of units. This is very valuable because it can tremendously help you make the best decision when picking your home. For example, if you plan to purchase a condo with a south-facing view and you find that there's going to be a building built right in front of that view, you probably will want to consider pricing that into your offer or look for another home outright. Plus, you'll be able to see how much supply would be added to the market near the location you desire and the timeframes it's estimated to be completed so that you can optimally plan when you would want to sell the unit. I've had so many seller clients who didn't know that their view would be blocked because their realtor didn't know how to look into this or didn't know how to. So use a realtor that knows how to use tools like these and also use it for yourself to double check. The second tip is to check the builder of the home. For condos, this is one of, if not the biggest factor to consider when purchasing a condo. Depending on the builder, especially if you are purchasing an assignment or pre-construction project that hasn't been built, the condo value drastically changes. Reputable builders have a premium to their name as they have a track record of finishing their projects on time, functional layouts, premium interior and exterior quality, higher quality residents, aftercare services, and attention to every detail as they have a lot of experience. Some of my favorites that I would highly recommend are Tridel, Great Gulf, Pemberton, and Concord. The third tip is to check the monthly expenses. There are 3 major expenses for condos: property taxes, maintenance fees, and mortgage payments. For detached, you would only have to pay the mortgage payments and the property taxes. My rule of thumb for maintenance fees is $1 per square foot. If it is higher than that, I would consider it pretty expensive, and below 75 cents per square foot, I would consider it very cheap. To future-proof high maintenance fee inflation, something all condo owners are afraid of, I recommend purchasing a condo with more than 400 units. The higher the number of units a condo has, usually the lower the maintenance fee and fee inflation, because there are more units to split the common expenses with. I know lofts are great, but their downside is that their maintenance fees generally tend to increase at a faster rate than high-rise buildings. Another recommendation is don't purchase a condo with a high-cost amenity such as a pool. Of course, we all love being able to use the swimming pool from time to time, but if you've ever lived in a condo with one, you probably never used it more than 5 times a year. You spend 98% of your time in your unit, so focus on the unit itself and try to avoid high-cost amenities. Finally, the fourth is to make sure the floor plan is functional. One of the biggest mistakes I made on my first home purchase was purchasing a condo that had a floor plan with an irregular design. The living room had a triangular shape, making it hard to fit furniture and optimally furnish the place. But I purchased it because it was cheap and I love the design of the kitchen. Later, it remained cheap and was hard to sell. So make sure all the floor plans are squared, minimal wasted space, hopefully without giant pillars. And if you can try to purchase at least a 1+ den unit where the den is rentable, as you will save a lot of money if you can rent out the den, or later save you from needing to upgrade to a bigger unit when you either move in with a significant other or just need extra space. The 5th step is preparing an offer for your home. This is where it gets pretty technical, so please pay attention. I'll go through the main details. In terms of price, homes in the GTA are usually sold 1% to 2% lower than their respective listing prices. But there are also homes that are listed for around 10% to 20% below the market price to drive attention to the property in hopes to bid the property up on the offer date to a higher price than they would receive if they just listed it for market price, which is called a bidding date. The second is irrevocability. This is the amount of time the buyers give the sellers or vice versa to accept the offer. Usually in Ontario, this is 24 hours, but depending on the situation, you can change this. The third is possession date. In the GTA, 45 to 60 days from the offer date is usually the possession date for the property. It is completely flexible on the terms of the buyer and seller if they both agree. Fourth, and the most important detail to focus on, is the conditions. This is written on the Schedule A of the purchase agreement. There are countless conditions that can be written on the offer, but there are 3 main ones you would have to focus on that protects you as the buyer, and the first is the mortgage financing condition. This is a condition that protects the buyer and gives you typically 3 to 5 business days to go to your bank with your offer and get approved for the mortgage on a specific property. Just because you received a pre-approval of how much you could afford doesn't mean the bank will actually give you that amount that they pre-approved you for. If the bank thinks that the property you purchased is too overvalued, they might not approve of the total amount that they promised on your pre-approval. The only banks that typically do give you the amount irrespective of the property you purchased is BMO and RBC. The second is the home inspection condition. This condition is for you to get a home inspector to come into the property within typically 5 business days of the offer being accepted to inspect any problems with the home. If you are satisfied with the state of the property, you would waive this condition and proceed with the purchase. The final condition is the status certificate condition. This is for condos and condo townhomes. And for those of you who don't know what this is, a status certificate is a legal document that provides detailed information about a condominium unit and its associated condominium corporation. It provides important information such as the financial information of the condo corporation, like the reserve fund, potential assessments, legal details, insurance coverage, and current status of the unit. In Ontario, the only person who should be giving you legal analysis of the status certificate is your real estate lawyer. Realtors can give you general advice, but you should take the status certificate that you receive from the seller and send it to your lawyer to make sure the condo has enough funds to prevent a huge increase in maintenance fees, or issue a special assessment, make sure the unit owner has been paying their maintenance fees and have been complying with the condominium rules, and many other detailed laws such as if your pet can live in the building with you. So for our last step, there are 2 types of closing costs: lawyer fees and land transfer tax. Once all the conditions have been satisfied, you went to your bank and got a final commitment for your mortgage stating that a certain amount at a certain rate will be landed to you. Status certificate is satisfactory to you and your lawyer's liking, and the home is in good condition. It is time for the buyer to waive those conditions and find a real estate lawyer. Your realtor can recommend a lawyer for you, or you can try to find a real estate lawyer yourself. And what you should consider is the lawyer fees and the reputation of the lawyer when picking one. Usually, real estate lawyer fees would cost you around $1,500 to $2,000, and your real estate lawyer will facilitate the fund transfer from buyer to seller, examine the title to make sure it is clear title, free of liens, encumbrances, or disputes, arrange title insurance, create a statement of adjustments, and settle any prorated property tax or maintenance fees to be paid, and most importantly, transfer the title of the property from seller to buyer. The final cost is land transfer tax. In Toronto, there are 2 types of land transfer tax: the Ontario land transfer tax and the Toronto land transfer tax. It is an incremental tax bracket, and both land transfer tax is the same amount as follows. So to calculate your land transfer tax in the city of Toronto, it'll be double these amounts. For a first-time home buyer, you can get up to the first $400,000 of land transfer tax credited, which is a $8,475 credit. That's it, you're set. With all the costs processed by your lawyer, the transaction is complete and you can pick up your keys through your lawyer. If you made it so far, congratulations on your purchase of your new home. Hopefully that was one of the most memorable experiences you've had. I've tried to cover all the main points, but if you want to go through the buying process in more detail or have any questions, please feel free to contact me via Instagram or number or the comment section below. Thank you, and I'll see you next time.